Ever wonder how some companies grow their profits twice as fast as their sales? Today, we are diving into the Q3 FY26 earnings review for JB Chemicals and Pharmaceuticals, a company often called the quality compounder for its sheer outperformance. JB Pharma just reported a solid 11% growth in revenue, reaching 1,065 crore rupees. But the real story is the net profit, which surged 22% to 198 crore rupees. This means profit is growing twice as fast as sales because operational leverage is kicking in, with EBITDA margins expanding to 28.7%. When we look at where the money comes from, the mix matters. Domestic formulations, which they call the fortress, make up 58% of revenue. International formulations provide the growth kick at 29%, while CDMO and others contribute the remaining 13%. Winning at home is key, and JB Pharma is doing just that with 620 crore in domestic revenue. They are consistently achieving a 1.3 times growth multiplier relative to the broader Indian pharma market, led by their flagship chronic brands. JB Pharma is a true cardiac powerhouse, ranking number 8 in cardiac therapy nationwide. Their brand, Cilacar, is now ranked number 3 in the entire cardiology segment. Because chronic therapies are growing at a 23% CAGR, this means stickier revenue and higher margins for the long term. On the global front, international formulations grew a massive 20% to 306 crore, with strong recovery in markets like the USA, Russia, and South Africa. While the CDMO sector was flat this quarter at 117 crore due to a high base last year, the company maintains a strategic moat as a top 5 global manufacturer of medicated lozenges. The efficiency story is undeniable. Gross margins expanded by 200 basis points thanks to lower raw material costs and a better product mix. This pushed operating EBITDA to 305 crore, proving that pricing power and cost discipline are winning out despite inflation. They have built a fortress balance sheet. While high growth usually consumes cash, JB Pharma is growing while generating a cash surplus. They have a stellar 32% return on capital employed and have even managed to slash finance costs by 27%. The company is currently investing for the future with 8 state-of-the-art facilities. Most importantly, all capital expenditure is funded via internal accruals with no new debt, focusing heavily on specialized OROS technology and lozenges. Growth here is also sustainable. JB Pharma has achieved an S&P Global ESG score of 86, ranking them among global leaders in the pharma sector. High ESG scores like this correlate with lower regulatory risk and better corporate governance. So what should you watch out for? There is some uncertainty regarding the amalgamation with Torrent Pharma, potential lumpiness in CDMO revenue, and the ongoing dependence on US FDA and South African regulatory approvals for exports. Overall, the investment thesis remains constructive. You're looking at a 1.3 times market growth multiplier, 32% ROCE, a top-tier global moat in lozenges, and margins expanding toward 29%. JB Chemicals, is it a prescription for wealth? If you found this breakdown helpful, make sure to like, subscribe, and share. Follow ZinvestZ for more smart investing insights. Thank you.